The four cardinal principles of trading, Bruce Babcock. Everything that reliably makes money in trading fits into four plain rules. And Bruce Babcock spent his career proving that almost nobody can follow them. Core thesis. Babcock was a lawyer who left the law to trade full-time and then did something almost nobody in the industry dares. He ran a service that bought the trading systems and advisory letters the industry was selling, traded them with real money, and published the honest results. That work made him a professional skeptic, and this book is what survived the testing. To seal the case, he interviewed around 30 successful traders, among them Larry Williams and Peter Brandt, and found that they disagreed about nearly every tactic while obeying exactly the same four structural laws. The four are almost insultingly public: trade in the direction of the intermediate term trend, cut losses short, let profits run, and limit what you risk on any single trade. Babcock's claim is that these are not four items on a longer list. They are the complete load-bearing structure, and every other choice, the indicator, the market, the entry trigger, is decoration hung on that frame. The edge was never a secret. It is the willingness to do four uncomfortable things with discipline every time for years. Trade with the trend. The first principle is to take the side the market is already moving, because trading against it is a bet that you can pick the exact moment the crowd is wrong, and the interviews are unanimous about how that game ends. His traders define the trend a dozen different ways, and Babcock deliberately lets them disagree, because the definition matters far less than the obedience. The reason he specifies the intermediate term is that a time frame is really a risk decision. The longest trends capture the biggest moves, but demand stops so wide they threaten the account, while the shortest signals drown in noise and costs. The middle ground, the moves that run for weeks to months, is where the trend is long enough to pay and the stop is small enough to survive. And the choice is the precondition for everything that follows, because you cannot let a profit run if you are not positioned inside a move that can actually run. Cut losses short. The second principle is the survival rule. Decide where the trade is wrong before you enter. Place the exit there and honor it without discussion. Every trader in the book has the stop decided before the position exists, because that makes the size of any loss a decision taken in calm rather than in panic. A long string of small controlled losses is survivable forever. One uncontrolled loss is how careers end. Babcock names the failure mode with precision. The trader who widens a stop to give the trade room is not being patient. They are refusing to be wrong and dressing the refusal up as strategy. A losing position is an attack on the ego, and the mind will produce any story to avoid closing it, which is exactly why the exit has to be decided by the calm version of you and enforced against the desperate one. Let profits run. The third principle is the mirror of the second, and Babcock admits it is the harder one. The urge to bank a profit and make it real is overwhelming, but obeying that urge caps the winners, and in a trend method, the winners must be large because a minority of them has to pay for the losing majority and still leave a profit. So his traders exit winners with trailing stops rather than fixed targets, deliberately letting the market decide when the ride is over instead of their own comfort. The price of the discipline is emotional. You watch open profit give some of itself back at the end of every trend, and you hold positions far past the point where taking the money would feel wonderful. Nearly every interview repeats the same confession. The year was made by a few trades that ran further than felt reasonable, and cutting those short is the single most expensive habit an aspiring trader has to unlearn. Together, the second and third principles manufacture the asymmetry that is the entire engine. Small losses by design, large winners by design, a matched pair that does nothing apart. Risk only a little on any one trade. The fourth principle governs size, and Babcock treats it as the master rule because it decides whether you are still present to apply the other three. Risk a small fixed slice of the account on each trade, and even a brutal losing streak is an inconvenience. Risk 10 times that and the identical signals on the identical market in the account. Same method, opposite fates decided entirely by size. He insists sizing matters more than the entries traders obsess over, and he accepts the unglamorous corollary without blinking. Small fixed risk means no single trade will ever make you rich, and that ceiling is simply the price of survival, which is the only precondition that matters. Osiris Capital Trading Desk runs this arithmetic with you on every position, a strict cap on the risk in any single trade and a hard daily line behind it. So the fourth principle is enforced before the first one is ever tested. Rules you can write down. Babcock's strongest personal conviction is that the four principles must live inside mechanical, written rules rather than inside a trader's judgment. Discretion feels sophisticated, but flexibility is precisely the property you do not want at the moment a loser is running against you, because that is when the human is least qualified to vote. A mechanical rule is emotion-proof by construction. The deeper reason is honesty. A method you can write down is a method you can test, and a method you can test is one you can actually know has an edge rather than merely hope does. Discretion is permanently unfalsifiable, every loss explained away as an exception, which is why it so rarely improves, and mechanical never means complicated. Babcock consistently favors simple systems because simplicity survives new data while complexity tends to have memorized the past. His standards for honest testing are the ones the industry still ignores. A system tuned until history looks perfect has learned nothing but that history. A backtest that ignores costs is fiction because the fast conditions where trend systems fire are exactly where fills come bad. And a result from one market over one lucky stretch proves nothing until it holds across many markets and long years with the rules held constant. Osiris Desk holds its own research to this same standard, treating tested results as evidence with a discount rather than promises, because Babcock's rule cuts both ways, and a system that grades the trader must first grade itself. Winning while being wrong, then comes the fact that makes the whole method psychologically brutal. A sound trend system is typically right on well under half of its trades, and it is highly profitable anyway, because the average winner is a large multiple of the average loser. The mathematics are impeccable, and the experience is misery. The lived reality is a long procession of small nagging losses, punctuated by rare enormous winners, and long droughts in trendless markets where the system bleeds patiently while waiting. Babcock's grim observation is that most people abandon the method at the exact bottom of that drought right before the trade that would have paid for all the waiting. The low win rate is not a flaw, it is a filter, and it is why a public, well-understood method keeps working. The rules can be learned in an afternoon. The stomach takes years. No holy grail, Babcock's skepticism was earned with real money, and his verdict on the industry of secrets was withering. The overwhelming majority of the systems and services he tested were worthless, and the entire market for them exists to sell to the part of a trader that wants to avoid the four principles discomfort. There is no indicator that removes the need to take losses, no oscillator that spares you the drawdown, no secret that replaces discipline. His punchline deflates a whole industry. The real edge is not proprietary at all. It is public, boring, and printed on the cover of his own book. The endless hunt for a better system is avoidance dressed as research, an attempt to buy a way around a behavior problem, and it fails every time because the problem was never the system. The trader already holds a method good enough to profit. What they lack is the willingness to run it. Through the drawdown, the final chapter activates everything else, because a tested, profitable system pays nothing unless it is followed through the drawdown that is mathematically guaranteed to arrive. The temptation to quit peaks just before recovery, since a drawdown feels most permanent at its deepest point, and the trader who caves there converts a temporary decline into a permanent failure. Babcock's defense is preparation instead of mid-battle willpower. Know the worst stretch your method has ever produced before you commit a pound to it. Size yourself so that a stretch of that depth is survivable in both money and nerve. Then pre-commit to holding the rules through at least that much pain, and remember the one instruction that carries the whole book. If you cannot stomach the drawdown, reduce your size, never your rules, because shrinking the bet keeps the method intact while tampering with the method destroys the very edge you tested for. Osiris Desk gives that instruction a voice at the moment it matters, bringing the size down with you after the heavy days while holding the rules exactly where they were. Bottom line, the four cardinal principles of trading is the plainest statement of the systematic case ever printed. 4 public rules written down as a mechanical method tested honestly against real costs and enough history, and followed with discipline through the losing stretches the mathematics guarantee. 30 successful traders disagreeing about every tool and agreeing about every principle are the proof that the tools were interchangeable and the architecture never was. The edge was never hidden. It is the willingness to do the uncomfortable, correct thing every single time, on purpose. The professional and the amateur often read the very same principles. What divides them is whether ideas like these travel past the page and into the next trade. Osiris Desk was built to make exactly that leap happen, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. It carries these ideas past the page by opening this very book at the screen and putting it to work in every session. It keeps you on the side of the trend, holds the matched pair of small losses and running winners. And when the drawdown arrives, it brings the size down and never the rules, until executing the 4 principles is simply how you trade.